Earnings season continues with both Microsoft and Meta reporting after the market closed yesterday, and whilst we did get a fairly flat market, nothing too glamorous going on in the S&P, we do believe today will be a lot different. Both companies reporting very strong earnings. We're going to cover them both very briefly, a bit of a valuation perspective as well. Starting off with Microsoft, as we can clearly see in the pre-market, they're up more than 8%, although over the last year they've not had the best performance, up only 1%, and year to date they are still down around 6%, but upon market open perhaps we can see them turn green on a year to date perspective, and longer term shareholders will know they have still massively outperformed the S&P, up 728%. With the company, as we will expect as the market opens, to be trading around the midpoint of the 52-week range, and Wall Street do still believe this company is a strong buy, as well as Seeking Alpha giving this the buy rating. Now, we've seen after their earnings a lot of analysts start to increase their price targets on the companies, both Meta and Microsoft. Starting off with Microsoft though, we have one analyst increasing their target to $550. We also have another one increasing it to $525. So analysts are now getting a lot more bullish on Microsoft after their very strong earnings. And let's highlight how they performed, with revenue increasing 13% year on year, with their fastest revenue growth driver being the cloud space, which was up 21%. That is some very good news, as people were anticipating the slowdown of this income stream. And if you just want to see a further breakdown, you can see on this graphic in terms of the other divisions. But one thing that continues, as we've highlighted, is their cloud revenue continues to increase with a compounded annual growth rate of 26% just over the last few years. And we can see they've also uplifted their forecast. In fact, when we take a look at the forecast versus actual performance, we can see Microsoft outperformed on both their top line as well as their bottom line. In fact, EPS, a very nice beat, 346, market was expecting 322. Revenue, likewise, another very strong performance, 70 billion, market was anticipating 68.42. And if we look towards this current quarter, they're anticipating the revenue in the 73.2 to 74.3 region, which even the middle range is higher than market expectation of 72.26 billion. So overall, very strong for Microsoft, and we notice that given investors are getting a lot more bullish, it is up nearly 10% in fact in the pre-market, and they expect some very large growth in terms of the cloud, 34 to 35%. As we can see, markets are only expecting 31.5, so we would say a very strong A rating in terms of their earnings, whilst also reiterating their capital expenditures. If you remembered, they were anticipating to spend 80 billion in 2025, something they do envision will happen by the end of the year. And we can see one of the things that maybe was a little bit below analyst expectations, although very marginally, was their operating margin, 43.35, market was expecting 43.5, and we also have to highlight their bottom line net income up 18% from the same quarter last year. And then when we look to the subsequent 4 quarters, we can see they're expecting every single one of them to be growth, fairly strong as well. They also have a 100% historical track record, something we always love to see. And for those that want to see their next full accounting period, well, based on the earnings per share of around $15, they're trading on 2026 numbers at a valuation of 26. And if we just currently look at their forward valuation of 29, it does sit below their 5-year average of 31.7. So this is what we would call an undervaluation signal. Although bear in mind, when the markets open, price will be higher and the forward P may come in a little bit more in line with the average. So definitely something to consider. And if we were to take a look at the 5-year average of the P ratio, which is indicated by the blue tunnel, but this does also highlight, based on that, the expected fair price, we can see at the moment it is sitting outside of this space, so you could argue another undervaluation signal. And even with the price increase as the market opens, it still will be trading towards the lower end, so again you could argue Microsoft could still be one for further consideration. And finally, before we get into our own valuation, we want to highlight institutions are continually bullish on this company, 71% ownership. They in fact sold around 115 billion worth of shares over the last 12 months, but in the same time frame, they bought nearly twice as much at 192 billion. And we also want to highlight on top of that, in quarter one, the latest quarter, they bought 21 billion worth of shares. They sold around 4 billion. So extremely obvious and clear to note, institutions have been and are currently very bullish on the company. And whilst we haven't got all of the super investors portfolio just yet in terms of the likes of Bill Gates, Bill Ackman, Warren Buffett, we can see from what we have at the moment, they are currently divided. Some have been trimming their positions whilst others have in fact been adding. But when we do get those more popular names come through, we will show you their buys and sells, so do make sure you are subscribed. So getting into our intrinsic value for the company, we get to $488 derived from the DCF model. Now we'll show you how we got to this with the free cash flow year on year. Average growth at 14%, we have gone for 16 moving forwards, although you can see we have a low, medium and high, 14, 16 and 18. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Microsoft or any others. But based at 16% with a discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 488, indicating 13% upside. We'll also show you, for those that believe that is a bit too high, at the 14% level at $424, whilst we do see downside of 1%, it isn't that far off the market price, so you could argue if you're adding to the company right now, already baked into the numbers is 14% growth to the future free cash flows, and for those that are a lot more bullish at 18%, 561, indicating 30% upside. As typical though, on the channel we will take through the medium rate, where we're not just done there because we do apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy at $439, then we keep going till it's near the current trading price. Now you're not getting 15% anymore given the rise in the pre-market. It is sitting right now 10 to 15%. Wall Street themselves see this at $520 over the next year, in turn giving it 21% upside. As always though, give us your thoughts based on these numbers. Is Microsoft a buy, hold or sell? And were you happy with the earnings report? We can also show you, for those that are interested, at 15% a buy at 415. For those that want to see a bit more, 20% MOS 390, and at 25 around 366. As we said though, sitting between 10 to 15%. Now before we move on to meta platforms, we just want to highlight we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. You'll also be able to gain access to a copy released just this morning on stocks that are severely undervalued this month. Lots of information for each one, as well as the upside that Wall Street themselves see over the next year, as well as a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to meta platforms, which is up not as much as Microsoft, but still around the 6 to 7% region. Over the last year, unlike Microsoft, actually very strong, up 28%. Year to date, down 6, so will at least turn green once the market opens for 2025. And over the last 10 years, the company is up nearly 600%. And similar to MSFT, it will open around the midpoint of the 52-week range, with Wall Street and Seeking Alpha giving the same ratings, a strong buy and a buy respectively. And we can see, very similar to what we saw for Microsoft, many analysts are increasing their price targets. We have Morgan Stanley here increasing it to $650. We have another analyst taking it higher to $720, and another increasing it, although not as much, to $655. Now getting straight to their earnings, their top line was up 16% year on year, very impressive, but we also noticed efficiencies to their operating profit, up 4 percentage points, as well as their bottom line up 5. And on top of that, their DAP, which is their daily active people users, has only been increasing every single single quarter. Definitely something very important to note, as this does help drive their top line revenue growth. And we can see shares are up as they did report stronger than expected revenue for the first quarter. And something maybe Nvidia investors will like to hear is that they've increased their 2025 capex spending, estimated to come in between $64 to $72 billion, as they said, an increase in the expected cost of infrastructure hardware. Now, if we take a look at the metrics that analysts will be eagerly looking at, that is in fact their EPS, which was an absolute large smash, $6.43, expectations $5.28, and similarly revenue very strong, $42 billion, analysts were expecting $41.4. And we can see for this current quarter they're expecting top line revenue $42.5 to $45.5, which is pretty much in line with analyst expectations around the $44 billion mark. And whilst other CEOs are struggling with the ongoing macroeconomic issues, we can see here that the CEO, Mark Zuckerberg, has actually come out to say that he thinks they're well positioned to navigate any of the uncertainty. And also quite some good news as well, they're expected to lower their 2025 total expenses, which will mean an increase to their bottom line. However, on the flip side to that, as we've already mentioned, they are expecting to increase their capex for the year. And they've put down here that this reflects the additional investment into data centers to support their AI efforts, as well as increase in the expected cost of infrastructure hardware. And we can see how impressive their earnings per share growth has been. Whilst we do note the dip where the share price was in fact lower than $100, ever since then it has only been increasing higher and higher, and they also seem to continually outperform what the market forecasts. Although moving forwards over the next 4 quarters, they only expect one of them to be growth, although you could argue they will massively outperform, as they have done. If you just look at the last 2 quarters, they've outperformed by more than $1, and they do have an historical 100% track record. And as we can see, based on 2026 numbers, they're trading at a forward valuation of 19.3, and whilst the forward P does sit at 22, below the 5-year rolling of 23.3, we do envision when the market opens this will pretty much be sitting in line with the average, which would give this a reasonable signal. Something that is also confirmed when we take a look at this model, whilst it is towards the lower end, which could indicate potential undervaluation. As we said in the pre-market, shares are up around 6 to 7%, so this will get slightly higher, although still well within that reasonable signal. And institutions who do hold around 80% ownership did sell around $47 billion just in the last 12 months, but they've been buying around twice as much at $99 billion. And we can also see in the most recent quarter, $18 billion worth of buying, $1.8 billion worth of selling. Incredibly bullish. Institutions do like this company, and quite a lot. Again, for consistency, like we did for Microsoft, when we do take a look at what the super investors have been doing for Meta platforms, we can actually see from those that have started to trickle in, every single one of them have started to reduce their positions. Whether or not that was a good move by them, only time will tell. Now, intrinsic value for the company does come in at just under $700, and when we take a look, we have used a growth rate at the lower end of 10%, but honestly, from the earnings that we have seen, the strong performance of the company, we could in reality use the median rate at 12%, which would come to $805, which we do believe could be seen as very reasonable. But if we are still very conservative and use the 10%, which is lower than just the most recent year at 23%, we get to $699, which still, even with the increase in the market today, does give a fairly attractive MOS. 20%, not quite there yet. You're getting at least 15% up to $595, which was more than what we saw from Microsoft, with Wall Street $720 price target on average, 24% upside. Now, we can also show you the MOS for those that believe 12% to be more appropriate, and clearly that will be at a higher rate, as in fact we too keep on going today. You're not getting 30% just yet, sitting somewhere between 25 to 30. As we said, Wall Street envisioned 24% upside just in the upcoming 12 months. As always, give us your thoughts on both Microsoft as well as Meta. What did you think about the earnings? Have you been buying? Are you holding? Or maybe the opposite, and you are considering selling your position? And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.